9 a.m. Let's call to order the February 3rd IMSARA Investment Committee meeting. Mr. Wickman, roll call, please.
Trustee Cooper,
Here.
Trustee Helwe.
Here.
Trustee Martinovich,
Here.
Trustee Poole,
Here.
Trustee Robbie,
Here.
Trustee Silverstein,
Here.
Trustee Vasquez,
Here.
Trustee Vila.
Here.
Trustee Werby,
Here.
Trustee Healy.
Here.
Trustee Jones is not here yet, and Trustee Jones is here, and Trustee Shaw is not. So, Mr. Chair, everybody's the committee is available except for Trustee Shaw.
And no request for teleconference.
There is no teleconference request today.
This is an open time for public expression. Do you have any members of the public or online? Thank you. Okay, we're beginning a section of the morning called Manager Reports, and we'll start with an overview by Jim Callahan of Callan LLC. Morning.
Thank you, Chris. Good morning, everyone. So you're going to hear from your 3 private credit managers here this morning. Just a little quick history. You committed $100 million to 3 managers back in 2020. It was part of what we labeled at the time an opportunistic allocation. It wasn't intended to try to capture some of the dislocations that were expected from COVID. These 3 managers, you committed capital to them. They called it over a period of time. They are now kind of through their investment period into their harvest phase, and they'll give you an update on their portfolios currently and how they see it kind of playing out into the future. So it's an update there. As the board knows, you've now created a dedicated target to private credit. At the time, you didn't have a strategic allocation to private credit, so these were part of an opportunistic part of your portfolio, which has a 0% target, but a range of investments. Now going forward, when we look at performance and your asset allocation, we're going to move these line items into private credit, and we're going to be coming back at subsequent meetings to talk about what you might do in the future for additional investments in private credit. So no more on that today, other than to hear the updates from your private credit manager. So with that, I'll stop and see if you have any questions. Otherwise, we can, I think, launch into the presentation.
Questions before we get started? Great. Okay. Let's welcome up to the podium our friends from AB Carval Investors, their Credit Value Fund 5, for Victor. We have Jody Gunderson and Matt Hansen. Thank you.
All right, excellent. Thank you. And thanks to the committee and staff for the opportunity. Appreciate this. We'll quickly get into bios. As I said, I'm Matt Hansen, principal in AllianceBernstein's capital formation team. I've been with the firm a little over 20 years.
I'm Jody Gunderson, a managing principal at Carvel and lead the firm with one of my partners.
So today we will provide an update on AB Carval's platform. We'll walk through an update on Credit Value Fund 5. And then we'll also plan to give color and commentary on market conditions driving the opportunity set as we enter into this harvest, with specific focus on asset-based finance, energy transition, and aviation leasing, which are really driving our opportunity set today. So at the AB Carval level, one thing you'll notice on this slide, which is different from last year, is James Ganley, one of our 3 managing principals, at the beginning of the year, identified that he would be retiring by the end of the year. And you'll also notice on the bottom of the page, David Fry, a 35-year veteran of Carval, and Matt Rempert, almost 20-year veteran, really involved heavily in risk management and portfolio management, areas that James was driving the last number of years. So very significant succession planning in place, ready to execute on that. James is a 30-plus year veteran of the investment management industry, and we obviously wish him well in his retirement. Also at the platform level, would identify very steady HR, really low turnover, and the ads that we are making are generally in the middle to junior levels across both asset-based finance and energy transition strategies. So let's get into Credit Value Fund 5 and your investment activity. So as Jim identified, this was a 2020 going into 2021 investment. Fund 5 is now in its second year of harvest. These are 6-year funds, 3-year invest, 3-year harvest. So now moving into that second year of harvest, and the harvest officially ending on June 1 of 27. To date, we've distributed 46 cents of capital relative to contributed capital. And the fund identify that from a return standpoint had another strong year with gross returns in the mid-teens range. And you see the net return here for the year just under 10%. But after a couple of years of back-to-back solid years, with the net IRR now is up to almost 8.5%, and continuing to see that activity going forward. On this page, a lot of black here, but let me walk through what's going on from a monthly perspective. Really steady performance you see here month over month, with a couple of blips in the summer. This fund has now a significant concentration of private markets exposure in it, specifically in that asset-based space that I mentioned. And because of that, see really good ability to predict returns here. And in the summer, there were a couple of exits that create that blip in return, but you'll see that there's just been a lot of significant steady performance in the fund throughout the months. And we would expect that to continue going forward because of that private markets exposure. And when we were here last year, we would have said, as the investment period was concluding, Fund 5 had really moved to an overweight in private markets exposure, seeing significant opportunities for illiquidity premiums in the market. We continue to see that today, again, across those three spots where we really focus in asset-based finance, energy transition, and aviation leasing. And as the fund becomes more concentrated because we're distributing capital back, we would expect that continues on going forward. Return of capital, I mentioned the 46 cents of capital that we've returned to date. We think by the end of the second year of harvest, we will have distributed at least 50 cents of capital. By the end of the third year of harvest, we'll be well over 80 cents return of capital. Again, the private markets exposure, not relying on the capital markets for those exits, gives us the ability to really model out when that happens, gives us good prediction of when that capital comes back. So we would expect we continue to see very steady, consistent distribution of capital. And I think, you'll hear from all your private credit managers today, but I expect you'll hear a common theme, which is private credit, especially on the asset-based side, has continued to offer really steady and predictable cash flow. And at a time when other strategies maybe aren't delivering that for you all, this is where private credit can really step up and deliver that. So we would expect you'll continue to see this through the harvest. On the portfolio itself, a lot of color and numbers here. So let me just walk through a couple of the specifics. It's kind of a continuation of the theme that I've been going down, which is CVF 5, very private markets focused, incredibly diversified across the areas that I mentioned. Specifically on the private side, over 70% of the transactions in here are private markets. And in the center of the circle, what you see is that over 2/3 of the return is coming from current yield. And that's, again, the private markets delivering that current yield relative to what we think is on offer in the public markets. And when you get to that point where you're just delivering so much of your overall return from current yield, gives you the ability to have that predictive feature and really feel comfortable with the predictions we're giving you and the modeling that we're giving you. So would expect that this model portfolio and returns continue to hold up going forward. And then finally on the takeaways here, I walked through where we're at in the harvest. We think that it is incredibly downside protected with all of that diversification in private markets exposure. And now that we're almost 50 cents distributed and we've got heavy concentration to privates, projecting out a net IRR around 10% and a multiple that's probably in the 1.4 to 1.5 range on a net basis. Again, feeling quite confident that we can deliver on that without a lot of public markets exposure in there. So maybe with that, Jody, I'll turn it over to you on the market.
Okay, sounds good. Thank you, Matt, and thank you for spending the time with us. Much appreciated. So I'll walk through the areas of focus in the fund that Matt just walked through and share some observations on fundamentals and what we see happening out in the market from a dynamics perspective across asset-based finance, energy transition, and aviation. So across any of these asset classes and sectors, if something made its way to the CVF 5 portfolio, it was at the intersection of two things: a big secular investable theme playing out in the market, and operators in each of these sectors that were in need of a capital solution. So let me just hit the key themes here in asset-based finance. It's all about the evolution in where credit is originated and funded, more and more so over the years outside of the banking system. So there we're providing capital solutions to both banks and non-bank originators of loans. In the energy transition space, the big themes here are the need for power, the capital intensity of the energy transition, and transactional activity that happens as a result of activity in the policy element of the market. So there we're providing solutions to developers of clean energy projects in the solar battery storage and energy efficiency sectors specifically. And then in aviation, we're seeing a major secular theme play out here, and we expect it to run for years, which is the shortage of aircraft relative to demand. So here we're investing in an aircraft and leasing it out to airlines around the world. So when we're dealing with the operators across any of these sectors, they're managing their capital, their balance sheets, and juggling the trade-offs between capital intensity of their business, growth in their business, and risk and profitability. Sometimes they're coming to us for solutions because they want to fuel their growth and they need the capital and financing to do that. Other times they're trying to de-risk and shrink their balance sheet and coming to us for those solutions. So let's dive a little bit deeper into asset-based finance, and I'll just start topside here on the size of the market. As you probably know at this point, we talked about it a little bit last year, the markets are enormous. These are all the credit markets effectively outside the corporate direct lending market. So all the markets that fuel the real economy. And in 2023, the market was 6.3 trillion, expected to continue to grow here in upcoming years. The biggest driver of this is regulatory considerations that are driving a lot of the lending outside of the banking space and into the non-bank market, specialty finance companies and others. So everybody's got their own definition of what is asset-based finance, and it can be quite a wide range of asset classes and credit that fuels the real economy. For us, it's really about the very granular loan portfolios. So think small balance consumer loans, residential loans, and small balance commercial real estate loans, where you get a portfolio effect, a ton of diversity when you're investing in these portfolios of loans. Typically, when we're investing, there's hundreds, thousands, or many thousands of loans in these portfolios. And we love the diversification of that. And as Matt was alluding to, these portfolios start to kick off cash flows immediately. And that is very de-risking. And we love the downside profile. And you don't have to wait for some refi or some IPO to get repaid. It's a natural and organic cash flow, which is attractive. So here's an example of a transaction. We've got many transactions like this in Credit Value Fund 5 today. This is a granular residential portfolio that we bought from a bank in Spain. And the total portfolio had a balance of 339 million euros. And there were almost 5,000 loans in this portfolio. So an average loan balance of 68,000 euros. And so very diversified and very well secured. The average loan to value ratio in the portfolio was 74%. And we bought this portfolio for 76 cents on the dollar. So at that discounted purchase price, we're really well secured. And this is a transaction that came through from a bank in Spain that needed to reduce the capital intensity of holding this portfolio on their balance sheet. It's called a reperforming loan portfolio, meaning at one point in the long history of these loans, the borrower went delinquent, and now they're performing again. Those are forever tainted from a regulatory capital perspective, making them unattractive for the banks to hold. So this is a perfect example. We've got a lot of residential portfolios like this across multiple markets in Europe in the portfolio. We also invest a lot, and in CVF5, there's a fair amount of exposure to consumer credit, and most of this exposure is in the US. So I thought I would, given the importance of the consumer to the macro and certainly to the fund, share some observations. And some of the risk considerations that we've been factoring in here over the last several years. The headline is this: there's a lot of dispersion in how the US consumer is doing today. Some consumers are doing really well, others a little bit more challenged. One of the things we see here, of course, with all the issues around inflation and affordability, is that the lower income tier is struggling a little bit more than, let's say, the mid and upper tier consumers. And you can see it in this chart on the left. Just looking at the level here recently of income growth and how you see that dispersion coming across with the lower income tiers lagging that income growth a bit. And then on the right, an important headline and something that we're very focused on: delinquencies for consumer loans are up in many parts of the consumer credit sector. And part of that is the inflation and affordability issues that have come through here since rates rose and we had the post-COVID inflation. And so we see kind of a new normal level of delinquencies on some of these portfolios. And it underscores the importance of underwriting to the market context that we expect to be in and what it means for consumers. Not all bad though. Got to watch the dispersion, but the consumer is still in reasonably good shape. We look at a few headline macro stats here just to share a couple important things. One is debt service levels remain about where they've been now for a number of years and reasonably manageable overall for consumers in the US. We keep an eye on deposits sitting in the bank, checking accounts, saving accounts. Those look okay. And then for the consumers that own properties, homes, financial assets, they're going to be benefiting from extraordinarily high levels of net worth, not at their peaks, but very high. We tend to focus on those kinds of consumers because they're doing better in this environment. And then finally, we watch closely lending standards. And we've had a period here over the last few years where lenders generally have been maintaining relatively tight standards to try to get those delinquencies under control. And that feels good to us. So
Jody,
yeah.
question just sort of like, so what are the, in this exact category, there are daily headlines about caps on interest rates for credit cards. Where are mortgage rates going in the US? Are there any bogeys on the horizon that you're looking at that would negatively or positively affect this fund?
Yeah, I think these portfolios now, because they've been on the books for a while and we can see the performance and the history, we feel like they're fairly predictable at this point. If to use your specific examples, Chris, like the cap on credit card rates, for us sitting on existing exposure, if consumers had their rates on their credit cards reduced, that would probably be credit positive for our existing exposure. I don't know whether that's going to happen. And then for the mortgage rates in our existing portfolio, the rate at which people could get new mortgage loans would affect the level of prepayment activity. And so we keep a close eye on that. And because the portfolios and exposure that we have to residential borrowers in the portfolio are mostly discounted purchases, if rates fall or mortgage rates fall, then we'll probably see more people being in the money to refi. And if we get that money back faster, we'll pull forward that discounted purchase price. So see that as a net positive. And of course, lower rates would be positive for the housing market and the underpinning of our collateral.
Vasquez?
In this portfolio, particularly the consumer side of things, what's your market geographic distribution? How much is in the United States as opposed to other markets around the world?
Yeah, we don't have any consumer exposure outside of the US and Europe, except for a very small consumer portfolio that's performing well in Mexico. But most of the consumer exposure we have in the fund would be in the US with a sprinkling in Europe. The reason we've seen more opportunities to invest in consumer portfolios in the US is it's a much larger consumer credit market. And in the US, originators of loans have the ability to risk-based price the loans, like charge enough yield to cover expected losses on the portfolio. We do less consumer investing in the European markets because many of those markets don't offer the flexibility to risk-based price the consumer credit. There's more intense usury limitations that we find limiting from a risk and return perspective.
Thank you.
Silverstein.
But nevertheless, you got this Spanish portfolio of loans there. And I'm just curious about the foreign exchange effects of the euro. Did you hedge that, or did the line of the dollar augment?
Yeah, we do hedge the currency risk always just as a matter of course, and our risk team leads that process.
Any questions?
Comment, the Spanish economy is actually doing quite well, so that Spanish investment should probably do well.
Absolutely. Yes, agree. Actually, yeah, it did really well. We've already taken our basis off the table
Great.
on that one. So yes.
Yeah, I was curious about the default that you were talking about. Was that at the property level, the individual owners level that they had defaults, or was there some overlying loan that you took on or something?
By reference to the 25% default assumption.
Well, that was an assumption, but you mentioned I thought you said you got a discount because some of these loans had been defaulted or had defaulted, and therefore they weren't marketable anymore.
Yeah, not so much that they weren't marketable. The reason for that significant discount in the purchase price is usually because the interest rate or the coupon on those loans in the European markets can be very low, kind of like most of the loans in the mortgage loans in the US are at low rates because everybody's locked in at the 3% rate. So if the coupon coming in on the loans is low, then we've got to pay a discounted purchase price to get enough yield.
Right.
And that's the biggest reason.
So prepayments are a great thing.
They're a great thing. Yes, absolutely. So the consumer exposure, the residential exposure in the portfolio is performing really well, and we can expect that it will continue to, given the fundamentals and underwritten expectations. On energy transition, a ton of dynamics in the market, obviously, but the bottom line is, notwithstanding all of the policy deliberations and noise in 2025, the energy transition marches on, and the reality is, when you look at all of the sources of new power generation capacity coming online in the US in 2025, 93% of that was solar, wind, and battery storage. So the orange, the red, and the purple here. You look historically, that's the case. And going forward, that will be the case. And you see a little bit of the above energy kind of coming in a little bit more in the future years, with the blue bar here representing natural gas. But some of the drivers here, really, it's not even so much about policy. It's about demand for power and the cost, which for renewables like solar and wind, it is the cheapest cost. So a couple very powerful drivers here on demand for power, with all the things you're seeing in the news every day now, with reindustrialization of the US, electrification, data centers, and AI. So when you look at the chart here, you can see an expectation for more power generation capacity coming online and meeting those needs. When we look at the cost side of the equation, there's a reason why solar wind and the combination of solar wind and battery storage is dominating here. It is the cheapest cost, and there's one major reason for it. The cost of the fuel is free, the sun and the wind, and so people are voting for it because it makes good economic sense. And in this environment where there's significant demand for power, the speed to power and being able to deploy that is also more important today than it has been. And let me just touch on policy, because it was important last year, and we were all watching to see what policy impacts would come through and how the Inflation Reduction Act and support for renewables would change. And there were some substantive changes, but I would say not as much as the market's worst case expectation. And so certainly on solar and wind, you saw a cutback in the eligibility period for investment tax credits. So everybody's trying to start construction on their projects so they can get those ITCs and get those subsidies. In today's environment, it's pulling a lot of that investment activity forward. So that's an attractive opportunity set. And then in general, battery storage is a winner here with investment tax credits and support running for many, many years, well into the 2030s, recognizing the importance of battery storage to the grid and to quote unquote firming renewables and the intermittency of the solar and wind assets. In CVFI, we don't have a lot of policy exposure, and that part of the portfolio, as Matt showed, is performing well, and we expect that to continue to be the case. And then in aviation leasing, one of the themes here, as I mentioned, is this massive shortage in aircraft relative to the demand for aircraft. And you can see it here in the graphic. The blue line or bar that's the trajectory of what we've seen historically in terms of delivery of aircraft. But since the supply chain issues post-COVID and some of Boeing's issues, fewer aircraft have been delivered than the market kind of would have expected or needs. We're, as it stands now, about 5,000 aircraft short. And then when you look out over the next 20 years, it's a very powerful fundamental dynamic here and very supportive because more aircraft are going to be needed to meet the demand, and we've got to replace aging aircraft. And between now and 2044, we're going to need 40-some thousand more aircraft. And the important element of that is, as we sit here and look at the aviation exposure in CVF5, is that supply demand imbalance is supportive to aircraft values, our collateral, our asset, and very supportive of lease rates that we charge to airlines and aviation lessors around the world. So quite happy with the exposure to aviation in the fund. And let me just conclude with a few takeaways here, and then we can address any other questions that you have. But the CVF5 portfolio, the predominance of investments in the fund are cash flowing and well secured by collateral. We're certainly focused in the harvest period on monetizing the remaining portfolio and investments, and see fundamentals as being constructive for purposes of monetizing those assets. And the opportunity set in aviation, energy transition, and asset-based finance continues to be strong, driven by those very powerful secular themes that are playing out. So that's what I had for you today. Happy to answer any other questions that you have.
Thank you, Jody. Ivanska.
Yes, thank you, Jody. On the aviation exposure, two related questions. Number one, the demand, this geographic distribution of demand, also in terms of markets, how much of that is driven ex-US, like international emerging markets, where the populations are growing and, blossoming, if you will. And then also part of the aviation demand side of things, how much of that is commercial and how much of that is defense related?
Okay, happy to answer that question. You're right. Most of that growth is in the emerging markets. And this has been a trend for a number of years, and we can expect it to continue. And it's really the result of increasing demand for travel by a massively growing middle class. So that's the key driver, not the only driver. And then all of the aircraft is going to be commercial aircraft. Yes, absolutely.
Thank you.
Go ahead, Trustee Robbie.
Quick question. Are you using leverage in the portfolio? And if so, what level is that at currently?
Yep, the leverage is going to be predominantly at the what we call the SPV level, so at the transaction level. And so if we invest in ABF or energy transition or aviation assets, often we will use leverage, and that leverage can range anywhere from an advance rate of, let's say, 40 or 50% of the market value of that investment to as high as 80, or if it's like almost investment grade exposure, could be 85%, I would say. But not everything in the fund is using leverage. For example, when we're investing in the energy transition and providing financing to developers backed by their portfolio projects, we wouldn't typically lever that, like almost never. But if we're investing in a project, let's say an energy transition project, we're right there at the asset level providing financing backed by the asset. Sometimes there would be senior financing ahead of us. So I would say we would call that structural leverage, not leverage we've gone out to get. So it's a mix, but we don't have much in the way of fund level leverage.
Thank you.
Vasquez?
Follow on to Trustee Robbins' question. So when you do use leverage, is it mostly at sub debt level, mezzanine level, or where in the capital structure do you mostly deploy your leverage?
Yeah, often we would be, let me give an example. Let me use that Spanish residential portfolio. We had debt financing, and if I'm remembering correctly, that would have been a 70% advance rate, give or take. And so we would own the whole asset, and that senior financing would be ahead of us, and we would keep the non-investment grade portion effectively.
Warby?
Yeah, I have a couple questions. One on the power thing, like we keep hearing about these small nuclear reactors and even fusion reactors coming online. Are those investable at this point?
Not for us. We've taken the stance, which is let's only invest in proven technologies. And so that certainly people are tapping into the aged existing nuclear facilities. For us, that would certainly be proven, but a little bit like too large, too much for us. We don't have the experience to do that. So we're focused on the technologies like solar, battery storage. We've done some wind where it's proven. I would say the small modular nuclear is way tomorrow from our point of view, but people are very focused on it as being promising.
And now you've had some exits. Have they validated the valuations that were placed on them?
Yes, I would say for the most part. Yes, absolutely.
Always a concern.
Of course it is. And the markets have done well here over the last year plus, and that makes it a particularly attractive time to monetize assets. And so we take every opportunity to do that.
And one more, obviously home prices and real estate prices are, housing prices are still very high. What would a decline in that do to the portfolio?
Probably not much, if anything, I would say. When we look at the residential exposure in CVF 5, a lot of it is in the European markets where most of these homeowners have been in their homes for many, many years, and like even before the GFC. And so they're well entrenched there. They're highly likely to stay. And because those portfolios are so well secured at this point, if like using that Spanish residential portfolio example where I said the loan to value ratio was 74%, housing prices would have to drop by, let's say, probably 30% because we bought that portfolio at a discount before we start to wonder too much about the impact on our outcomes. And then another important point, and we see this across the European markets, even some of the markets in the US, even though there's some dispersion here at this point, very supportive home prices because there's a shortage of housing in many of those markets. owing to the post GFC lack of new build supply. And so that is a very powerful dynamic that supports house values.
Just one final question. And Jody, thanks. So obviously some headlines around First Brands last year. You had some exposure. Can you talk a little about how you saw that, how it's playing out, just to address that topic?
Okay, yeah, happy to. And Matt, maybe you're better positioned to do that than I am. Okay,
So
thank you very much.
it has been in the headlines quite a bit. We had two financings there to businesses that were market leaders at the time, specifically brake pads and wiper blades. It was a bit of a cross-border financing between Mexican domiciled parts coming into their US business, and they had a market dominant position in the US. So we had financed that business on balance sheet. We've we've verified all of our collateral. We've had audits done. We have UCC protection filings on all of our positions. So we feel good from that regard. That it's an active case. It's in litigation. So there's not a lot that can be said outside of discovery that's obviously filed. So I think everybody's seen that they got a dip at the end of last year. And I think the real discussion that's playing out is how that advances. Is there another dip necessary or not? How does the going concern go forward? There was some recent press in the last week that the principals there, I think, have now been brought up on some formal charges. So, another iteration in it. But I think for us, the bottom line is that we move forward specifically because of the business that we were supporting, the market dominant position that they were in, and our ability to get first lien collateral or first lien pledge on all of the collateral, which as of our most recent audit, which was post the filing, collateral value still well in excess of our outstanding loan balance. And, we'll see how the bankruptcy continues on in its process. So apologies, that might be a little bit more long-winded, but I'm happy to provide more color that Jim, as you need it. Thanks.
One last question before we move on, Trustee Vasquez.
Thank you for that update. Very helpful. You can view the First Brand situation as idiosyncratic. I'm always concerned about when's that inflection point between idiosyncratic and then systemic. So my question to you is, what did you learn from that experience, and what kind of assurances can we have on the rest of the portfolio going forward that we're not caught blindsided?
Yes. As far as is it idiosyncratic versus systemic, I think, for people who've been through a few cycles, I think the place where the systemic piece comes in and where we saw that create a lot of problems in the past is when the people who are underwriting the risk ultimately just move the risk along as opposed to ever having skin in the game and having to really wear that risk. And so I think just, at the most macro level from a private credit perspective, I think the growth in private credit has largely been with originators who are wearing the risk. And so they're usually wearing it in a structure that has low levels of leverage as well, compared to the banks, obviously at 30 times leverage going into the financial crisis and moving that risk along as quickly as they could back in the 08, 09 timeframe. So I don't, at least our view is it's not systemic in that regard. As far as things that you learn along the way in that, so I think we were one of the few in the First Brand situation that had a perfected security interest in their collateral. I think we're one of the few that had rights in their document to be in those warehouses on a quarterly basis, identifying their collateral, ensuring that it was there, ensuring the values. And so those are things you learn along the way. And I think that's one of the things that's helped protect us to this point in the case. It feels like, versus maybe some of the other stories that we're seeing and hearing and reading about, just like you are, from the discovery that comes along. So we don't, from what we've seen in the discovery, what we've been able to learn, we don't think we have double pledged collateral like a lot of people ended up with there. And I think that's because of those learnings that you gain along the way. So hopefully that answers your question.
Thank you.
Yeah.
Thank you.
All right, Jody.
Okay.
Matt, thank you very
Thank you.
much. And let's move along and welcome Max Safian and Sean Peterson from Fortress Investment Group, LLC.
So before, Mr. Chair, before Fortress begins to present, I think that Trustee Robbie has something he would like to share with the board.
Go ahead, Mr. Yoni.
Just I wanted to share that with the committee that I have an investment in a REIT that is managed by an affiliate of Fortress Group, and for that reason, I will be recusing myself from participating in this part of the meeting as it relates to this Fortress presentation. So that's advice of counsel that I step out of the meeting during this section, and then I'll come back afterwards.
All right, we'll see
Right,
you
thank
then.
you.
Thank you.
Morning, everyone. It's great to be here. And first off, I want to thank MCERA for inviting us here today and for the continued support and partnership. Thank you to Callan as well for the continued support and interest in our strategies. My name is Sean Peterson. I'm part of the Client and Product Solutions Group at Fortress. I work very closely with Jill Chanis and Danny Kane. I'm very excited to introduce Max Safian, who joins me today. Max has been with Fortress for 20 years. He works very closely on many of the investments that go into your portfolio. Fortress Credit Opportunities Fund 5 expansion. Max is also a local based out of our Menlo office. Before I turn over to Max, I'd like to just touch on a few updates from the Fortress side. Turning over to page 5, you'll see a snapshot of the business. As you can see, we are currently a $54 billion assets under management business. We have over 400 investments and asset management professionals globally, and we operate within 13 offices around the world, dual headquartered between New York and Dallas. Flipping over to page 6, you'll see that we continue to operate within 3 major verticals: corporates, asset-backed finance, and real estate. Appreciating the broad approach we take with our Fortress Credit Opportunities funds, your portfolio has exposure to all 3 verticals. The 3 verticals are led by 3 senior members of our business: Drew McKnight, our co-CEO, who leads corporates; Jack Newmark, also co-CEO, who leads our asset-backed finance business; and Tim Sloan, who is our vice chairman, who leads our real estate initiatives. Another firm update that I wanted to address that you might be aware of is the passing of our co-CEO, Josh Pack, in September of last year. Josh was a day one employee of Fortress and really helped to build the business to where it is today. He was a strong mentor for many of the folks who continue to lead the firm forward today. In the wake of his passing, the firm has really rallied together to honor him, and we continue to manage portfolios, grow the business the way he would have wanted us to do. Jack Newmark was already a managing partner. Flip over to the page, on page 8. He was already a managing partner and president of the firm. He has stepped in as co-CEO and will continue to lead the business alongside Drew McKnight. Josh really focused and prided himself on the development and growth of the investment team, employees that will continue to lead them forward. And Max is one of the senior members of our investment team, someone that worked very closely with Josh for many years. So with that, I'll turn it over to Max, who will run through portfolio and provide you an update on FCO5 expansion.
Good morning, Max Safian. Sean stole a little bit of my thunder with that I'm a local. It was nice coming across the bridge here. So been at Fortress for just about 20 years. I run our financial services vertical. I think we might do this a little bit differently than maybe some of the other funds do. Generally speaking, there's one senior partner who's responsible for effectively everything within an industry. Mine happens to be financial services. That can also move into travel. There's some crypto, sort of distressed crypto investments we've done in the past. That means that we are agnostic to which fund we're investing in. So if it's loans or opportunistic or, our core Drawbridge Special Opportunities Fund, that would fall under us. We think that gives us, a lot more flexibility and a lot sort of ability to sort of see the entire space. Appreciate your all support. This is a 2020 vintage fund. So we were investing in one of the most challenging environments in recent years. We're excited about the success. We're in harvest mode right now. We're very excited about what the future holds. I'll touch on sort of the existing portfolio, what we think about going forward. But I'd be remiss not to mention Josh's name. Sean's been here for less than a year. I've been here for 20 years. I worked with Josh, that entire time. He was a mentor, a friend. I think he really taught me a lot of what I know right now. We became very close in the last few years. We're sad to see him go. I think we think about him all the time. To Sean's point, Drew and Jack have taken over, and I don't think we've missed a beat with that going forward. So why don't we skip to page 10 here. This is a quick summary of the fund. FCO5 expansion held its final close in November 2020. Total fund commitments are $5.9 billion. The fund has called and committed 125% of investor commitments, just about 125% of investment commitments. If we fast forward to November 2024, that's the end of the investment period after 4 years. We think we deployed successfully. And to date, we've been able to return just about 40 cents of that capital called, which we are proud of and plan to continue. If we go to page 11, just as a reminder what FCO5 expansion is, it offers an incredibly broad mandate. Its ability to invest in stressed, distressed, special situations, other opportunistic transactions across the sectors listed on that page. We really think about this as sort of a go anywhere fund. I think the variety of colors on that page speak to that. We deploy into real estate, corporate debt and securities, direct lending, specialty assets, etc. One of the reasons that we think about the success of the FCO franchise, really is this broad mandate and flexibility. From all the way to the senior partners to the more juniors, are sourcing, underwriting investments across really a broad range of the credit spectrum. We look at all these asset classes all the time. We look at it in real time. And I think having the ability to sit across a number of funds, really gives us that flexibility to pick the best things that should go into FCO5 expansion. And that upshot is the flexibility of FCO5. We can produce opportunistic returns, really absent a massive dislocation or recession. If we skip to page 14, this gives you a little bit more of a detailed overview of your investment. So reminder, we closed in 2020, just under $6 billion of investor commitments for this fund. To date, the fund has made 165 investments in 13 different portfolios and asset classes. This gives you a snapshot sort of through the end of 2025. Of your $33 million commitment, we've called $35 million and invested and committed to approximately $42 million. That foots to what we talked about at the beginning of this. The $42 million is approximately 125% of your commitment. This is really due to the ability to recycle in those early years. And if we sort of roll this forward, we've redistributed $15 million of your commitment, bringing the net equity invested to just about $19 million. Our current DPI, we mentioned, was 0.4 times. That's after only a single year of harvest period. Obviously, this is the most important thing. We're super committed to returning you folks all your capital. If we look at the 930 portfolio, if the fund were to be liquidated at the September NAV, it would generate just about $1.5 billion of gain. And then I think in there's the asset leverage that's just about 49%. And just, following up from a question that was asked earlier, that is generally non-recourse asset level financing. So it's not crossed. That is at each of the assets. Page 15. This is the realized proceeds page. The fund has generated close to $1.1 billion of realized proceeds, and that's across 13 asset classes. Almost 30% of those came from the fund's common equity and corporate securities portfolio. The table at the far right shows the top 10 realized proceeds. I know those are just generally noted. I can talk sort of high level about those. That first one, the common equity for 215, that's a large non-US asset. It's shown as common equity. I think there's a huge real estate bend there. Again, sort of shows the ability to move across sectors, work together across teams. I think that was a very successful investment from us. The second one, that's the $91 million one. That's a true real estate investment, really out of our core real estate team led by Tim Sloan. The second and third, those are consumer loan / forward flow investments. We've done a lot of those. We continue to do a lot of those. I think we're excited by that. And then the fifth is a European corporate distress name. What I think you all hopefully get from this slide is, those are 5 completely different assets that are in this portfolio managed by, generally separate teams. I think that sort of goes to this truly go anywhere philosophy we have for the FCOs in general. Move to page 16. This shows what you have today in the portfolio. This list represents the top 10 investments by market value. The investment period ended November 2024. So this is what is left in the portfolio. Continues to be very diverse. Real estate, infra, their coupons and pref flows. I think we're excited by this. And I can just touch on, generally speaking, that some of those names on the right side of the portfolio, and we'll get into this maybe at the very end, but the top one is a real estate portfolio we bought post-COVID that has a number of assets, lots of ways to create cash flows and get out. The second one, which I'd love to talk about at the very end, is an infrastructure asset. That's $213 million. That's really at the cross-section of AI and energy. The third is common equity. But again, similar to the page before, it's listed as corporate securities or common equity, but that was done out of our legal assets group. Ability to source deals, maybe that others don't see, excuse me, because of our ability to touch a number of different asset classes. And then the fourth is a net lease portfolio. That's in a well-known brand that we continue to be excited about. The next few pages are sort of more market commentary. I think really the most important one, and I think hopefully the thing that we leave you with, is this page 18, and that's the shift from banks to private credit providers. We continue to be very excited by this. We have a couple of pages in here. Page 20 gives a little bit of what we think is the potential addressable market. That shows 15 trillion. I guess I've been lucky or unlucky enough to have been through all 4 of those smaller light blue bars. It's pretty incredible what the potential could be in the future. Really dwarfs everything we've seen up until that time. And then page 21, we put this together, bit of a thought piece here, but gives you an idea as to kind of what we think this theme yields. This is the market's move to the alternative capital provider. So this is fund agnostic. We see this as just, something close to 6 trillion of assets that will no longer fit on banks' balance sheets, that will need to be sucked up by the alternative asset manager universe. And if you look at the little orange bar at the bottom right, That's only 1.3 trillion. So we see, a real opportunity there going forward. A couple other themes in the following pages. I think most of these, you continue to hear about. We're happy to touch on them. I think maybe more interesting might be some of the investments left in your portfolio that we can touch on. One is this forward flow that we have with SoFi. Dom Ruggiero, who I'd suggest all of you to reach out and discuss. He runs that group. They've done a terrific job kind of in asset level financing. They've been doing this longer than just about anybody have. Their loss rates are almost close to zero. We can touch a little bit on the questions around First Brands and Tricolor. They talk a lot about how we've avoided both of those and why we avoided both of those. We're excited by this forward flow with SoFi. It's a self-liquidating portfolio. The second one, and that listed sort of on that previous page, is this energy infrastructure, which is APR. This is a mobile energy business. You can move the units from area to area. I know we bought this as if it was an asset portfolio and sort of nailed this snap in AI energy demand from AI. So what looked like sort of an asset level purchase will turn into something more like a company level multiple of cash flows, hopefully. And then the third is a low price gym operator. Interesting deal, structured, excited by it. I think, again, you've got a forward flow, you've got an energy infrastructure play, and you've got a low price gym operator, three completely different assets. Again, the sort of go anywhere thought. And then just lastly, page 28. These are the key near-term opportunities. I'll touch on each of these just quickly. The corporates is near and dear to my heart. That's effectively the group that I work through. Let's skip Europe. Let's do fund solutions and private equity. This is a lot of this, 1.5 or 6 trillion coming off of bank balance sheets. The amount of stranded LP capital is just phenomenal. I think I saw some quote that said there were more hedge funds than there are McDonald's in the United States. And that always gets us kind of excited. I think there are lots and lots of ways to take advantage of that situation. That could be by buying LP units at a discount. That could be by structuring interesting deals where there's a GP-LP component to it. I think a lot of folks want their money back quickly, and I think there are some really interesting ways for us to provide that. We have an entire group that's focused, specifically on that. And then corporate opportunities. This is really corporate distress. It's what I grew up in. It's worth maybe just touching on this a little bit. There's not a ton of corporate distress in this FCO5 expansion portfolio. I think a lot of that is this concept of these LMEs. I'm happy to discuss these, now or later if you'd all want. But really, the issue has been, for as long as distress has existed, there's a concept, there's a priority of payments. That means if you think a company is worth X dollars, that X dollars flows through the capital structure in a certain way. I think, in the last 5 years, the underlying documents have become completely wishy-washy, which has meant if you think an auto supplier is worth $500 million, it's almost meaningless because another lender can, sneak dollars up senior to you and sort of make all that work moot. I think what's interesting is when these companies go through these large restructurings, they reset the capital structure. And I think we see that as sort of a really interesting opportunity in the future. Asset-backed finance, this is a broad mandate we have. This is legal assets. This is investing, lending against various legal-focused firms. Forward flows, I think that's what we spoke about a little bit as well. We agree with the previous Carval, the previous statement that the sort of risk for the consumer is bifurcated. And I think we've been very focused on sort of finding the right areas to go after. Then intellectual property is a pretty unique business we run. This is a patent lending investing business, gives us a lot of sort of interesting deals on the back that we don't think many of our competitors have. And then finally, real estate, that's headed by Tim Sloan. He was the ex-CEO of Wells Fargo. Just a ton of really, really good relationships and ability to manage risk. We have a great team there. You know, the sort of macro there, I'm sure you've all seen a number of times, but massive maturity wall, banks that are, you know, tons of assets on them that we think could be interesting. Those are kind of the three areas we see going forward and our focus. I don't know, unless Sean, do you have any wrap up, or happy to open it up for questions?
Thank you. Any questions, Trustee Silverstein?
Yeah, on the foreign investments, the foreign currency risk, that hedge.
100% hedged. Yep.
Ambassador?
16 trillion in potential addressable market. What is the geographic distribution of that? How much of that is US now, and how much is ex-US, international, and emerging markets?
I believe that page is US. I'm almost positive that that's US. I'm happy to get back to you. I don't want to give an answer without being-
Arguably, ex-US is even market.
It would be even bigger. Yeah, that's correct.
And they're
I believe that's
inefficient,
US banks.
unique opportunities.
Yep.
More questions?
Yeah,
Go ahead.
I may know the answer to this question,
Yeah.
but I don't want to guess. You said that invested capital is 125% of commitments. That's not obvious how that happens.
You want to take that one, Sean? That's the concept of being able to recycle the capital in those early years. So while you're still in the investment period, you can invest $1 twice, basically.
I'm just confused about the footnotes, because there's footnotes on this page and they don't seem to go anywhere.
You mean the references?
14 it's got 6 footnotes, and I don't know where
That should be in the back of the deck.
in the appendix.
In the appendix, yes.
Because I looked over there, and it's possible they all tie, but it wasn't very clear.
The only reason why I think so is because when you asked the question on recourse debt, I referred back to our own index notes, or at least the one I have in front of me has the appendix to page. Was it page 14 that you're talking about? We're happy to send you another one if that's.
I actually did look, but I couldn't exactly tie it, but I wasn't. It was hard. I just wanted, if that's the answer, that's fine.
Okay.
Yeah, we can check back in.
And then maybe just to head off a question, we had zero exposure to First Brands or Tricolor, or Tricolor as it is.
Oh, and my other question about exits, are they substantiating evaluations that you had?
Yes, for sure. I think we're pretty excited about a couple of those in that page 10 of kind of where they could eventually land as well.
Okay, with no more questions, Max, Sean, thank you very much.
Thank you all so much.
Thank you very much.
Thank you.
And let's keep it moving and welcome Jim Dunbar, Hannah Toro from Varde Partners.
And let's just get Trustee Robbins back.
Please, thank you.
Morning.
Morning.
You wait a few minutes.
Oh, wait, just one moment
Sure.
until one of our trustees return. Yeah. Okay, go ahead, welcome.
Thank you. Well, thank you very much for having us here today, and thank you for your partnership over the years. I'm Hannah Turo. I'm part of the business development and investor relations team at Varde. Jim Dunbar is an investment partner at Varde. He's been with the firm since 2010. In 2006,
Just one moment, Hannah. Just
Yes.
you remove
Oh.
the mic, just a hair, I can't quite.
sorry. Thank you. Would you like me to start over?
No, that's fine. Thank you.
Okay.
You're good.
So Jim is an investment partner at the firm. He's been with us since 2010. Importantly, he launched the commercial real estate lending business for Varde in 2016, a business that he continues to manage and run today. Forward to page 4. Before we turn it over to Jim and a little bit more detail on the investment side, we did want to spend a few minutes just giving you a recap and an update on the broader Varde platform. So as some of you may be aware, Varde is a global credit specialist. We have a 33-year history in credit. Our roots are in distressed, but over the course of 3 decades, we've really evolved with the broader credit markets, with our credit counterparties, with our investors. So today, the firm's investment strategy really centers around 4 core businesses at Varde, or 4 core investment verticals: commercial real estate, asset-based finance, corporate credit, and Asia credit. You'll see that we have about $16 billion across the Varde platform. We've deployed over $100 billion over the years. That's across both private and public markets. That really, I think, is a testament to our expertise, our ability to originate, trade, and restructure credit. Importantly, we can do so on a global basis. You'll see that we have offices in New York, Minneapolis, London, Singapore, and Mumbai. That's supported by 183 employees around the world, 57 investment professionals. It's really important to us as a team to make sure that we're hiring locally, that we're establishing significant senior presence in each of these offices, so that we're establishing a right to play barriers to entry. One thing that's not on this page that I think is important is that Jim and the other senior investment partners at Varde have worked together for an average of 17 years, and that's together at Varde. So they've navigated a number of cycles together as a team at the same firm. We also remain 100% employee owned. So we've prepared a few slides to review the portfolio, the market backdrop, the opportunity set ahead, but please feel free to interrupt, ask questions. We'll, of course, save time at the end for any other questions. Jim?
Thank you, Hannah. Thanks, everybody, for having us here today. I'm just going to turn to page 8. I think that's 8. Might be 6. Might need glasses, apparently. Anyways, thanks for having us, and I'll walk through here our dislocation fund snapshot on this page. I think this was a 2020 vintage vehicle, and really the mandate of this vehicle was looking to take advantage of dislocations across credit markets in those 4 different investing verticals that Hannah mentioned earlier. It was a relatively short investment period, so June of 2022 is when the investment period ended. I think, you know, that led to a relatively quick harvest period and you know, a shorter opportunity set, especially as stimulus came into the market and took some of those dislocations away relatively quickly. And I'll talk through some of the exposures that remain in the portfolio in a couple of slides. Even though I know there's a lot of redactions on this page, let me talk you through a couple of points here. I think the fund itself has performed right around a net 9% return, with to date as December 31st, 2025, about a 1.3 times multiple. We expect that that net IRR to stay very close, slightly higher at 9%, but that multiple to increase to about a 1.4 times. We have, because we're 3 years into the harvest period now, distributed almost 100% of the called capital back to investors, including yourself. And so that remaining AUM is really the distribution of the profit, which we expect to be distributed here over the next 2 years, with I would say an emphasis on 2026 distributions. Turning to the page, it is page 7. Turning to the next page here, just to give you an overview of how this fund was invested, and given that dislocation aspect of it, where we first saw those dislocations and opportunities, was within our corporate traded credit business. And so you'll see on the left here, that was the large majority of how this fund was invested in 2020 and into 2021. That corporate credit includes both the traded component, but also what we did in a more private credit fashion in the Asia region, largely in Indonesia, India, and Australia over the course of 21 and 22. There's also real estate private credit exposure, which I'll go into more detail about. But our asset-backed finance, a relatively small part of this fund, as we just didn't see as many dislocation opportunities there. Ultimately, there were 229 positions that we took within this vehicle. We invested over $4 billion, and that was because of the liquid aspect and trading in and out of positions and recycling capital over the course of the investment period. Page 8 now. So a couple of the key performance drivers for you here, really across those three verticals. In the real estate sleeve, I think those, the U.S. hotel to student and the CRE lending, that was a theme we saw across the hospitality space, and you'll hear this across a couple of these. There was a lot of travel themes that we deployed into in this fund. In the hotel space, we both lent very senior in the capital stack, where there was less liquidity being provided by traditional banks and insurance companies. But then we also acquired distressed loans from a number of banks on hotels in urban cities like New York and Boston, and then ultimately took ownership of those assets, converted them into student housing assets for local universities that needed beds for their students. And that was that position actually continues to be the largest exposure. I'll touch on it a little bit more here. We also did capital providing to home builders, as there were a lot of starts through the 21 and 22 timeframe. In the corporate credit space, that was more of the traded liquid securities. There, it was taking, I would say, opportunities in dislocated credits where we saw prices trade down, especially in travel-related themes, such as airlines, some hotel companies, some cruise companies, and also largely in European financials. The final piece, Asia credit, some of the themes that we took advantage of there was providing capital largely to larger conglomerates where we got multiple pieces of collateral. This was largely in the mining and the power sector across a couple of jurisdictions in Asia. And again, I'll touch on that in a little bit more detail here. Hitting on, ultimately some of the performance drivers here. I believe you can see the detail in your printed decks here, but the top performers are more in the private credit space, just longer duration that the vehicle has had exposure to these positions. Those top two positions, the first one is that lending that we did, first mortgages to hotels that were across the U.S. That portfolio, we've seen a significant amount of paybacks over the course of 24 and 25 in that portfolio. The second one is that hotel to student housing conversion. So those two real estate themes, really big drivers of profit within this vehicle. And then the final three, that private lending to asset-backed conglomerates in the Asia Pacific region. The bottom five, which is on the right there, just to give you a flavor of what didn't work as we expected. Ultimately, this fund in those 229 positions, we saw over a 4-to-1 times kind of winners, if you will, to positions that didn't work out as we expected, and that was largely driven in some of those corporate credit situations where the fundamentals just didn't rebound or moved against us. And then one real estate position there that was a development financing that ultimately got caught in a number of issues around permitting and just ultimately took longer, which led to poor performance there. So page 10, there it is. Page 10, this is the portfolio as it sits today. So, significantly a much higher real estate component as that corporate credit piece has traded down. That corporate credit, the 61% is split. 37% is the Asia private credit. The 24% is traded credit and largely North American for the real estate and the traded credit with the Asia credit. Private credit being what's sitting in that Asia bucket there in the geography pie chart. The last slide I just wanted to touch on for the fund very specifically here is these top 10 positions. So these 10 positions are about 75% of the remaining exposure in the vehicle. The top 4 are actually 50%. So a couple of more concentrated positions here that we're going to look to exit here in 26 and into 27. But to give you a flavor for some of these, that top position, as I mentioned before, it's a portfolio of the hotel to student conversions. There's actually 6 underlying assets in there, largely New York focused, Boston, and some Bay Area exposure here as well within that portfolio. Those assets are actually master leased to universities, so very strong credit from a cash flow perspective there. And we actually just refinanced that portfolio, bringing some cash back to the fund in the fourth quarter of last year as we look to now exit that portfolio here going forward. The other real estate positions I touched, number 5, that's the lending portfolio, and number 9, I think, is a good example of where we provided capital for a condominium development in Phoenix when capital wasn't able to finance that. That's actually been a very successful transaction for us. We've fully gotten our capital back and are selling the last units there now to bring the profit back in that transaction. There's 2 corporate credit transactions that are still traded credit in North America, number 2 and number 6. Those are positions that we haven't sold. They are tradable positions. They're ones that have very strong current income to them. So think low double digits, where we think there's some fundamental upside to trade out of those over the course of 26. One of them we actually expect a refinancing to close in the coming weeks that will bring that capital back to us. And then finally, five positions in Asia, which I've touched on. Those are collateralized by multiple assets. And to give you a sense of what those are, there's a number of power plants in there. There's 2 of them have exposure to gold mining, both in Indonesia and in Australia. And then there's some real estate development assets in there in India as well. And so as we think about those positions, they're very much driven by strong sponsorship and groups that we know well, providing capital where we have multiple times coverage for the dollars that we're lending there. That's the overview of the fund itself. I think what we wanted to do here as well in some of these coming pages with page 13 was just touch on how we see the market continuing to evolve, some of the opportunity set that we see at Värde going forward for us, but also I think some of these points will tie into providing exits for those last positions in the Värde Dislocation Fund as well. And so page 13, I think Värde, as Hannah was mentioning, has always been focused on the credit markets. We've continued to evolve along with those markets, and historically more of a distressed firm, more and more doing lending into these positions. Like I talked about, providing capital where there's dislocations or where we can take opportunities to provide more structured solution to owners of assets that are cash generative. And we just see that continuing to grow here with just a brief, I would say, dislocation during the pandemic. Page 14, I think just interesting to see the slide that was up just before us here. I think actually very similar numbers here. I can tell you 15, is sort of a similar number. We see 5 to 6 outside of the securitized product market. That's a US based number here you'll see. I think, Hannah mentioned I spent a lot of time in real estate. I think for that real estate, to give you a sense of it, we think that's about a $600 to $700 billion opportunity in the US. Europe's about 50% of that number. We see that as about a $300 to $350 million number. I think Asia we see actually a similar opportunity, but it's less from the banks, pulling back or not providing credit. It's just a continued growth and opportunity set as those markets develop, and there's more and more companies that need access to that credit. So more, I would say, we're able to come in there and help innovate markets versus taking market share, if you will, from the banking system. Just to touch on the three key parts of the platform that we have at Varde. Real estate, real quick. I think the opportunity set as we see it going forward here the next couple of years, and this will feed into paying off a couple of those last hotel loans that we have in VDF, is there's about $2.5 trillion of loans coming due in 2026 and 2027 across the real estate space. It's largely a regional banking pullback opportunity as we see it, to provide capital where they historically provided capital. They'll still be a large player, but we can supplement that, and that feeds into that $600 to $700 million opportunity that I talked about. How do we create that? And this is an example of the hotel lending you have exposure to. On the left there, it just shows we write a first mortgage, so we're senior on that underlying property. That's typically a 70% loan to value. In that middle column, then what we do is we finance that portfolio through bank partners or through the capital markets by issuing securitizations. So effectively creating a mezzanine tranche to that underlying real estate asset, 50 to 70% part of the capital structure for real estate. And that's providing a low to mid-teens return. So we think a very attractive way to create that exposure rather than acquiring it, say through Wall Street or through other parties. Asset-backed finance, not a lot of exposure to that in the Varde Dislocation Fund, but a part of the market we're doing more and more of. Historically, we've done a lot of this at Varde. Think about this as portfolios largely of underlying consumer or commercial assets that are very cash generative, where we either acquire those or we're funding originators. And the opportunity set, I think, largely is driven by, one, banks pulling back, but two, also technology gains by a lot of non-bank lenders that we can then come in and fund and take that credit risk. And so this is an opportunity set we see continuing to evolve here. This page just lays out what parts of that market we play in. And so really commercial finance, think about that as equipment, think about it as small businesses. We have some forward flow agreements with payment groups, such as, an example of that would be Toast. If you go pay at a lot of restaurants, their payment systems, Toast provides loans to a lot of those underlying restaurants. And then we are the ones ultimately taking that credit risk, getting paid back through those terminals where they take the payments. So creative ways to create that risk. Consumer, we do play in that space as well. I think similar view, it sounds like you've heard before. I think kind of a bifurcated market there. Consumer, we're doing less in right now, but a part of the market we continue to watch. And then fund finance, as we call it, really being able to work with GPs either through NAV lines or ways to get liquidity back to limited partners, given the, I would say, slowdown in distributions largely across the private equity space. And so this area, along with subscription lines, is a part of the market where banks need more capital just because their underlying balance sheets are not growing at the speed alternative assets are. And so creating a big opportunity for us to come and provide that capital. Finally, Asia private credit, just a couple points here around the supply demand. And I mentioned this earlier. I think this is an opportunity where we can just come in, be innovative with some of our financing structures and relationships around the region versus specifically a pullback in the banking system. And this slide tries to lay out where we sit within those capital structures. The exposure that you have within the Dislocation Fund really sits in that capital solutions bucket. So it is lending to sponsors. It's in the mezzanine part of these capital structures, but secured by multiple assets to really provide a lot of downside protection. So with that, I'll kind of end prepared comments, but would love to answer any questions that anybody might have on the fund or some of the opportunities that we see.
Let's start with trustee Silverstein.
Same question I asked before about hedging on foreign investment.
Yep.
That's been additive or not, or
Yeah, we hedge everything back 100% to US dollars at the time of origination. And so over the course of the VDF fund, the dollars obviously fluctuated a decent amount. I couldn't tell you the exact number as to if that has been a drag or not in the fund, but everything that we do does get hedged back to US dollars at the time of origination.
Vasquez?
Yes, my question relates to covenant standards.
Mhm.
Given the underpenetration in non-US markets for private credit, and also given that a substantial amount of the portfolio is in Asia and Europe, what's your experience been in differing covenant standards in Asia, Europe, relative to the United States? Equal? Are they looser? Have covenant standards strengthened, both in ex-US and also within the United States? That's my question.
Yeah. I think it depends a little bit if you're looking at public or into the private credit markets. I think
Private.
yeah. From a private credit, I think, the reason we've been doing more and more in private credit is because we can get stronger covenants. It's definitely relative to the US public markets and a lot of the liability management exercises that are going on here in that market today. Specifically as it relates geographically from a private credit perspective, in Asia specifically, where we're doing a lot of this, we actually think we get much stronger covenant packages and we get multiple pieces of collateral because the credit markets, one, are not as competitive or as liquid and, I guess,
Inefficient?
yeah, they're a little more inefficient. I think the key there is really focusing on the right sponsors. And so a number of the groups that we have lent to, we've done a number of deals with, and that becomes a very key aspect of it, obviously, and then making sure you're structuring those covenants in the right legal jurisdictions from an enforcement perspective as well.
Thank you so much.
Yep.
Any other questions for Jim or Hannah? Go ahead.
Yeah, same question that I asked before about exits. Are they validating the valuations that were placed on them?
They are, yes.
Very much.
Great. Thank you, everybody.
Okay, before we go into the discussion on private equity commitments, let's take a 10-minute break. So we will re-adjourn at 10:40 hours. Calling the investment committee meeting back to order. The next item on the agenda is to discuss private equity commitments. We're going to get a presentation from friends at Callan, and this is an action item.
Okay, great. Yeah, we're going to switch gears and pivot to private equity for a second, just to reintroduce our colleague, David Wong, who's a member of our private equity research and consulting team. I'm going to spend just a quick few minutes recapping where we've been and what the goal is today. David's going to spend a little time talking about the program, answer any questions that you may have, and we'll get into talking a little about Pathway and some of the developments there, because that's certainly key to the decision that you're being asked to make today. So back in September, David was here. We talked about the private equity portfolio, so our annual review. And part of that process is we do a pacing analysis to determine future commitments to private equity so that you can stay in line with your 8% target over a long period of time. And the recommendation that we made at the time was to commit $120 million to private equity going forward, which the board approved. Purposely at that meeting, we asked not to make a specific dollar commitment to your existing managers, Abbott Pathway, because we were given some indication that there may be an organizational development at Pathway, which may impact how you might think about that commitment. Subsequent to that, Pathways come out and as we talked about at the last meeting, they announced that they were selling their firm to Clearlake, which is a private equity manager. Clearlake was making a strategic investment in them, not putting it into one of their private equity funds, but actually using their own balance sheet capital to invest in Pathway, to be their solutions-oriented part of their business to help them grow into the future. So we talked a little about that at the last meeting, talked about some pros and cons and concerns around that. The full board was here. There were still a few blanks that we wanted to fill in. And so what the board decided to do at the December meeting was to take half of that $120 million commitment and committed $60 million to Abbott, which is one of the managers without any issues on the plate. And then to circle back at a future meeting today and in the future, if we need to talk about how to commit that other $60 million. And really, there's three things you could do here with that 60 million. One is you could continue with what you've done in the past, which is equally split your commitment amount between Abbott and Pathway. That's option one. The second option would be, if you do have concerns about Pathway going forward, would be to take all of the 120 and give it all to Abbott. And then the third would be, if you were uncomfortable with giving the entire commitment to one single manager in Abbott, but uncomfortable with the Pathway story, would be that you could look for a new gatekeeper for that additional $60 million of commitment. So those are kind of the three things again, right? Keep doing what you've done in the past. We'll talk through the Pathway situation as we know it, get comfortable with that and say, yeah, we're just going to move forward. Give it all to Abbott, which creates some concentration, obviously, and a break from your dual gatekeeper model that you've had in the past. And then the third would be keep the dual gatekeeper model, but hire someone moving forward to replace that role that Pathways played in the past. So let me just pause there and see if there's any sort of questions or comments before we launch in. That's kind of where we are and what we're hoping to get done today.
Yeah, I go ahead. I have an additional concern. It may or may not be shared by the rest of the board, but I'm going to put it out there. At some point, this board, before I was a member, made the decision to go with this fund of funds concept, and the idea being to make it less risky and pay more fees as a result. Everybody I've ever talked to thinks that that's a bad idea. When we did our private credit thing, we didn't even consider that kind of an approach. You brought us a number of managers. We had a clear a favorite in that group, but we weren't able to put all the money with it. But that, this board was validated as we just seen by the returns that the three are reporting, that we can make that decision. We're not that bad at trying to, decide between managers, which ones we think are good. So we could also, alternative to what you suggested, we could also either pick, you could bring us a number of private equity managers, not fund of funds, so we only pay one set of fees. Or we could divide it potentially between, say, three. We could, do the same kind of thing that we did with the private credit. We could put $20 million into three of them, and therefore have that same kind of not putting all our eggs in one basket.
Okay, so it's actually probably a pretty good segue into this slide here, and I'll just maybe make a quick comment on it, but we'll get into it. And I guess what you're describing, Todd, is what we call a direct program, where instead of using a gatekeeper to make underlying commitments in partnerships, is you just do it yourself. Look at the bottom of this page. That's how many direct partnerships your gatekeepers have committed to over the course of your program. I can't do the math that quick, but that's hundreds.
Right.
Without an investment staff and with limited resources as an organization, there's no way you could implement that. MSARA could implement that effectively in a direct capacity.
That wasn't one of my one of my suggestions, right?
I thought that's what you were getting.
No, not to try to do hundreds. Pick three.
Oh, well, even if you were to go in a direct model and concentrate this,
You could bring I'm sure that Callan could bring us 10 good candidates, 5 good candidates.
yeah, it's a completely different model of implementing. And it is something that we put on the table back last year, but we never really got to because, the view is it's a complete different way to implement your program that would require a lot of education and thought process to get to, and you're really not there right now as an organization.
What's the additional information or education or thought process that we would need to do private equity as opposed to what we did for what effectively turned out to be private credit?
You would, again, operationally, doing it direct is just a very completely different thing. I mean, we did 3 private credit partnerships before. It was a lot of work and we stopped, right? Going forward, if you were to move to a direct model, it would have a lot of drain on resources, time, energy, board resources, expertise. If you look at institutional investors that are doing that model, they typically have a pretty well-established and experienced investment staff that's doing private equity. Okay, so it's a very different model. I don't want to poo-poo it because we work with a bunch of clients that do it that way. But I think the point was that given where you are now, given the 120 million of commitment that the board agreed to, we don't think that you're equipped to move to that model now for the reasons that some of them that I pointed out to. We can certainly do the education, and I think that's what we decided was let's continue to have this conversation and see if it's a right model to move forward with it. But David's going to talk about the program in a little more detail again to remind you. It's been very successful, and net of the fees that you've paid your managers, it's delivered a very good return for MSARA. It's been your best performing asset class since you've had it. Net of the fees that you've paid your gatekeepers. And you haven't had to deal with any of these operational burdens that you would have to take on as an organization if you were to move to a direct model.
Okay, in order for me to do, you're gonna have to explain to me what those are, because I don't see what the difference is being you're a limited partner.
Yeah. So again, as it works now, you commit, let's just say you commit $60 million to Abbott in their fund, AP26. What they're going to then do is over the next 3 years, they'll make commitments to partnerships in 2026, 2027, and 2028 of that 60 million again. And they're going to build you a diversified portfolio. It's going to have exposure to buyouts of different size, maybe some venture capital. It may have European funds. It may have other types of investments that may be in there. Underlying in those funds, you're probably going to have 20 to 25 different partnerships maybe over that 3-year period of time. Okay, so that's how you allocate to them. You don't actually have to go in and pick, do I want to be in buyout X or buyout Y or this venture? How do I allocate it between venture and buyout? You don't make those decisions. You give Abbott that discretion to build that portfolio for you.
But haven't we just seen that there's at least 3 firms that do exactly,
That's private credit. That's a completely
was-
different asset class. We're not talking about private credit. We're talking about private equity. I'm telling you that it's a completely different implementation model that the board is not ready to dive into yet without education and awareness and what it means for the board and what it means for staff and other resource allocation. You're not there.
Yeah,
Trustee Vasquez?
yes. I've heard you say that before, Jim, in terms of us not being ready to basically internalize or bring some of that function in-house, if you will, whether at the board level or at the staff level. Having done private equity investing in a prior professional life and having had institutional clients that were pension boards that I serve, I'm curious and doing exactly what Trustee Werby is alluding to. What is that inflection point in your eyes, Jim? When is the board and when is MSERA ready to bring that in-house? We started this private equity program in 2013. I was not around then. I don't know what the offhand, I'm sure I could figure out what the assets under management were back then, but I'm sure we are in a better position and footing today in terms of our funded ratio. No, without definitely credit to all of you, Callan, our staff. But when, in your eyes, in your opinion, informed opinion, will we be ready? Given the tailwinds that we have in terms of performance, funded ratio, and if I remember correctly, our administrator says we are at about, our liquidity position is quite strong. I see nothing but tailwinds in terms of increasing our assets under management here. And the need for an organizational and operational capacity is knocking on our door as opposed to 2013. So in your informed opinion, when will we be ready?
So the size of your assets,
And the
ten-
allocation.
the
too.
tenure of your program has nothing to do with that.
Okay.
MSERA is structured exactly the same as it was in 2008 in terms of how the governance model works and how decisions get made, and that hasn't changed.
Okay.
And the decision was made then that the resources were not necessarily in place to build out a complex direct
Yep.
program. You have the assets to do it.
Are we outgrowing our governance model?
No, I don't think you are.
Perhaps.
I think the governance model has been very successful.
Mm-hmm.
And I think it still works for MSERA. I think it's completely reasonable to do a deeper dive on education and what it actually would mean for resources. We pointed that out before. The issue today is you have $120 million or $60 million to do it. And I don't think you're ready to take on a direct investment of that $60 million right now. In the future, you may get comfortable with it. I don't think there's enough awareness that you as trustees and fiduciaries could say, yeah, we want to move to a direct model right
I've seen a lot of trustees boards myself, and I'm not just complimenting my board, but this is probably one of the more educated and sophisticated, financially sophisticated boards I have seen in my 30-year experience in this field. All I'm gonna say.
Mr. Silverstein?
So I want to say that in the private equity game, the whole thing is being in the top quartile or the top 2 quartiles. The dispersion of returns across all the ones is so vast that it's a losing game if you end up with somebody in the bottom quartile, which can happen. So, having the expertise to pick people who consistently are in the top quartile or top 2 quartiles is worth a lot in terms of risk reduction. And so we have had these fund-of-fund managers, and we pay them a
Good amount.
a decent amount of money, but they end up choosing winners. And if we were to make those choices, what makes us think that we're going to do as well as they have done? And of course, if we do as well as they have done, we will have saved, I don't know, $1 million a year or whatever it is. You can tell us how much we would save and how much additional risk or variability we might be subjected to. So speaking for myself, I'm all for lowering fees. That's money down the drain, is these fees. But on the other hand, we've done real well on this, and I'm satisfied with this. Yes, we pay a little bit more than if we were able to pick the home runs ourselves, but that's just a little too risky for me.
Yeah, and those are certainly good points that you bring up. And I think part of the broader conversation of what are the trade-offs of doing it and what are the things that you need to be aware of as a board. So I would encourage you to have a more holistic decision on and education on the topic before you were to plunge into that. We're certainly happy to help with that. But again, I think that the conversations we've had to date have been more towards continuing with the gatekeeper model in some capacity for the existing commitment of 120.
I think Trustee Hill, we had a question.
Yeah, I wanted to ask, how is this different from, are the 3 managers that presented today considered, what do you think, indirect? I mean, is it direct? Okay, and this model we're talking about here is totally different?
Yeah, so when the decision was made to commit to these 3 managers, it was considered an opportunistic decision right after COVID or right during COVID. And again, it was intended to try to capture an expected dislocation in the market, which materialized, closed quickly. And so it was a little bit of a different model of implementation in terms of trying to capture that dislocation at that point in time, and that was determined the right way to do it, as opposed to the creation of a strategic asset class and how's the best way to implement that exposure strategically over time. So they were a little bit of a different sort of mindset. But yes, the decision was to invest in 3 direct private credit offerings, which is what you heard from today. And the question on the table is, would going direct in private equity make sense going forward to not pay fees, et cetera? And again, there's pros and cons of doing it.
So with this with Abbott's model and rest is giving money for those people who then will decide to which manager.
So when you commit $60 million to Abbott, Abbott's then the one that's picking the underlying partnerships.
Okay. And then a quick question to Jeff, probably. Any decision made by this committee today, does it need to go back to the board, or since it is the same body, is considered done?
The answer to that question is, you are correct, is that because this is the full board you would not have to return it to the board for separate ratification.
Okay, so our discussion today is about the $60 million. I think we can have a discussion further about a direct investment idea, but that it would follow upstaffing at MSERA and much work that would go into a very big picture, and that's not what we're addressing today.
Can I ask one more question?
Yes.
Because I totally agree with what Trustee Silverstein said. He's 100% right on that. But for example, does Fortress have some kind of an investment vehicle that we could use? They're consistently in the top 25%, top quartile, I believe.
Are you talking about private credit or
Private equity.
There's lots of good private equity managers out there that you could invest in directly.
Are there, I mean, I assume that there's some that are consistently in the top quartile.
There are some that have.
This doesn't mean
consistently-
that doesn't mean that it will be going forward, past
demonstrated good
performance.
Yes, the answer to that question is yes.
Is Fortress one of them?
Yeah, I mean, Fortress has had a lot of success as an organization. You have them in a private credit capacity,
I
not a
understand, I
private
was
equity
talking about
capacity.
different.
So it's completely different ballgame.
David, I'm sorry, I didn't mean to interrupt, but we keep throwing around quartiles and statistics and empirics, having done plenty of them myself too. I have a question about the databases that you guys use that determine first, second, third, fourth, fifth quartile, fourth quartiles. Since we've been in the program, has the size of your database increased? You have an internal database that you gather from managers that are, looking to do business? Or are you purchasing databases from, say, Cambridge or Preqin and compiling it all together? In other words, I know in the market, the number of private equity managers has increased. I think there's more private equity managers than there are securities in the world because of the economics. It's so attractive for just to get in the business and raise money. But your database, Callan's database, with which you report the results back to us, is it an internal database? Do you purchase it, or do you do a combination of the two that spits out the second quartile results?
The answer is a combination of all of what you said, because there's no perfect database.
Exactly.
There's no perfect peer group out
Mhm.
there. So we do purchase the Cambridge database.
Okay.
That we use to do peer
Sure.
quartiling. And then we have our own internal database that we use for the basis of our due diligence and planning the forward calendar, so to speak, understanding which managers are in the marketplace now
Mhm.
and which ones will be expected to come into the marketplace a year from now, 2 years from now.
Has the size of that database increased from 2013 to today? And if so, by how much?
I can't give you the exact statistics, but it's well over 5,000 managers in there. It's a big database.
Okay.
I wasn't
Cambridge is a
in.
little smaller.
Good. I don't mean to take more time. We can have an offline discussion.
It
Yeah.
really is sort of
Okay.
a database of institutional quality funds. But we triangulate from the perspective of making sure that we have data that we're not tracking internally. So we use the Cambridge database for peer group quartiling.
Okay.
And then we have data that's reported to us directly that we can verify the quality of. that
Okay.
we can't verify necessarily with Cambridge, and so we triangulate.
Thank you.
Jeff, did you have a comment?
So I want to support what I heard the chair saying, which is that, and also what Callan has said, is that the discussion today is around what you're doing with the 60 million of your $120 million. And we can discuss the direct model. That can be something that we can do in the workshop, which is not far off at this point, and have a whole discussion of that. But I think today is about what are you doing with your current commitment? And that's not the time to talk about necessarily trying to do that direct. I also want to say that I don't believe there's a threshold that once you get to 4 million, you suddenly should have staff. All right. Because really it's about how do you invest to maximize returns to pay the promised benefits. And if you're doing a good job with that, which in my estimation you are, because you're the second highest funded of the Searle systems and you don't have any internal investment staff. So then you should really back up. And it's not about once we get to a number, we need people. It's about what are you trying to do from an investment perspective that having staff would help you achieve? Because there's a cost with that too. So I don't.
And Jeff,
Can I finish, please? So it's not about a number that you're getting to. It's about your objective that you're trying to achieve. And I haven't heard that objective that it's better than what you're doing right now. It's not that it couldn't be, but we should discuss that.
Okay. We are, there's no doubt that there's been a lot of success, for sure. But I don't want to give into recency bias. Okay. What's happened before doesn't mean that it's going to continue on the same way going forward. As the needs are increasing, we will hit a point where capacity constraints will be an issue. If we keep, especially if we keep allocating to private markets, which I'm not against doing. But the level of sophistication, what do you have, a team of 6 doing private credit, private equity? I mean, and for the amount of business that's getting done in that area, yeah, having some internal capacity to do that going forward, given where the markets are going in terms of exposure to private markets, I think is at some point is merits a real conversation.
Okay, thank you, Trustee Vasquez. Trustee Silverstein, did you have anything to say?
No, I just wanted to say that these databases ranking people in quartiles are based on past performance. And we know past performance is not necessarily a predictor of future performance. That a fund can be doing really well in the past performance, but that there is some kind of manager change that's coming up, in which case, you know, if you're going to invest in them, it's a whole new game there. So I wouldn't rely just on picking people who in the past have done well. You need to know the stability of the management team, whether change is coming on and so on and so forth. It requires a lot of work to be on top of this, because you're in these funds for 15 years, 20 years. There's going to be a lot of changes in there. So,
okay, thank you. I think it might be helpful, since we've tabled this from December and here we are in February, to maybe seek a motion regarding the $60 million, and through that discussion, we might be able to move forward. So the ideas that Jim proposed are putting the $60 million into Pathway as we would have, or perhaps doing a split of that money between Abbott and Pathway once again. And if someone has another motion out of left field, we could entertain that as well. Go ahead.
I'd like to make a motion that we allocate the $60 million to Pathways to complement the $60 million we've committed to Abbott.
Okay, we have a motion on the table. Any discussion? Go ahead.
I thought,
Need a second.
Oh, you're right. A second on that one?
Second.
Trustee Martinovich.
and I thought David's gonna go through something before we decide on this. Or-
It's up to the board as to how you want to.
well,
Sorry, I got so lost in the.
Otherwise, I have questions.
Conversation.
Yeah, I mean, again, what we were going to do is give a quick recap of the program and then talk a little about the Pathway situation as we understand it.
Yes,
To inform that. I
Okay.
mean, the motion's out there. That's no reason we can't do that, but that's.
Yeah, we have a motion on the table with a second. Let's, in the discussion period, get some more information and then we can vote on it. Thank you.
I do have a point in discussion about this.
Go ahead.
At the motion. So Pathway has, you know, you highlighted here that it's now in the 3rd quartile, which raises an eyebrow. So my question then is it in the 3rd quartile because of something intrinsic? There are various funds are in the 3rd quartile, I should say. There's Fund 7, they're 9, they're 10. Across all, you know, the performance metrics, the IIRs, the TPPIs, and DPIs. So, and then the last 2 funds with which we committed to, they're not meaningful results as of late. So my question then is what what is it intrinsic to these three vintages that has declined in terms of performance and quartiles or pathway? Or is it something unique to the database? Again, because during that period is when you actually see a lot more private equity funds raising funds and becoming parts of these databases. So is it the database or is it something unique to Pathway that we should be considering that their performance is at the middle?
Let's see if David has
Yeah,
it in his
and
presentation.
we can go to the I guess it's slide 15. I think in aggregate, Pathways performance really overall is second quartile. It does have some periods where, depending on the measure, it flips between third quartile and first quartile.
Okay.
So it's a little bit more volatile.
Okay.
But it's not across all of those metrics. And when you sum up the entirety of the track record, it's overall second quartile. So I would characterize it as being still pretty consistent. And what's sort of endemic about Pathway's approach compared to Abbott, for example, Pathway historically hasn't used secondaries as intensively as Abbott has. And so secondaries tend to smooth out
Sure, yeah.
returns a little bit. And so it tends to have a little bit more volatility than Abbott. And then also Pathway tends to focus on much smaller funds, and then they also have had more non-US exposure than the more of, say, cyclical type of exposure, which can introduce more risk, but they've gotten paid over long periods of time to, you know, by having that exposure. So I wouldn't say that there's anything broken about Pathway's process. It's just where they put their exposures, and it tends to produce, you know, at the risk of a little bit more volatility, but better returns over long periods of time. So we don't, when we kind of go back to our stoplight assessment on Pathway, we still think that their performance is within expectations. We have it as a green. Still second quartile performance over long periods of time is pretty commendable given the dispersion. But we do have it as cautionary is the organizational change that's occurred.
Can you tell us about what your thoughts are on that?
Yeah, and so you all are familiar with the transaction that Pathway was acquired by Clearlake Capital, another large alternative manager, focusing a little bit more on buyout and credit type strategies. And so what the acquisition does is that from Clearlake's perspective, it actually provides capability to them that it didn't really have initially. So Pathway has a very strong capability in investing in a sort of multi-manager platform across primary, secondaries, and co-investments. Those vehicles, those strategies are very conducive towards structuring evergreen structures or products that may be a little bit more targeted towards the retail investor. So there's a strategic rationale for Clearlake to acquire Pathway from that perspective. And then we also see some strategic rationale for Pathway to be acquired Clearlake as well, in that it provides a solution to the succession problem. So they had three co-founding partners who were looking to generate liquidity. They controlled about 2/3 of Pathway, and so the remainder of the firm didn't necessarily have the financial wherewithal to buy them down. So this provides that clean succession plan, so to speak. And then I think Pathway can also benefit by certain synergies, you know, with technology, marketing. You know, Clearlake tends to have more of a distribution network in sort of non-US markets, and so Pathway could use that in order to provide another avenue for growth. So there is a strategic rationale for the combination. what we wanted to focus on in this was, is there cultural alignment? Is there a risk to staff retention? Could there be some conflicts that arise that prevent Pathway from executing its strategy? So I think we got comfortable that there are some certain safeguards in place that from an independence perspective and governance perspective that really don't interfere in the way Pathway prosecutes its strategy. So they will remain independent. They'll have their own management committee. They will essentially control their destiny from that perspective of investing. It was important that they also provide that there were, say, safeguards for information walls, because they're investing in primary funds, and they didn't want to compromise their ability to source investments, right? So there's an information wall, it's a systems wall, such that their information is not going to be shared with their. And then I think the 3 co-founding partners are kind of moving to the side. The 19 current investment partners have been given some incentive to stay. You know, they are now holding Clearlake stock, which has a 5-year lockup. There's an equity pool that they can distribute to the middle level of professionals, so that now there's a little bit more of a mechanism for this sort of next generation of investment professionals to really control their destiny, distinct from what the 3 co-founding partners were thinking. So from that perspective, you know, these combinations occur very frequently. And since the Pathway announcement, we've got a lot more announcements of combinations. But we feel that ultimately, again, from the strategic rational perspective, not exactly clear outside of the synergies that I mentioned what Pathway gains from the transaction and what you might get. But at the same time, we don't see an imminent risk in how the strategy is being implemented, how Pathway will be able to manage its relationships with you, for example. So from that perspective, it's hard to know how these things will progress. And, you know, again, the initiative that I mentioned that Clearlake is thinking of, really tapping into the retail marketplace, what that will mean in terms of resource distraction or coordination effort. So that's why we have it as we're still monitoring, because we don't know how it's going to.
So they're losing their top 3 people, and you don't see it as being a risk to us?
The management of the portfolios is being done by 19 investment partners. The 3 co-founders are generation or 2 older.
The management of the business and of the investment process has been thoughtfully transitioned, but clearly there's this big equity position that, you know, was, I think, the driver for the transaction. So yeah, but we're comfortable that they've been thoughtful about transition.
Oh, I'd just like to chime in. I think Jim made a good point. This has been our best performing asset class across the whole portfolio. It's averaged 14%, and the 2 Abbott and Pathway funds are, one's 14, one's 14.1, almost identical performance. And we're in 14 funds right now already with Abbott and Pathways, and that's going to continue for years. So I see this as being one of our more successful strategies. We've gotten good advice, and we're getting the advice that what's working is still working, and I don't think we should try to second guess the advice we're getting today.
David, continue if you have more information regarding this decision.
I think
Yeah, we're happy to dive in more, answer questions or anything like that. But yeah, I think that, you know, we wanted to just give you an update on what we had learned. You know, there were, again, questions about people, stability, motivation. You know, they're being thoughtful about that, governance, same thing, conflict of interest policies. It won't, in prior funds that you've had investments in Clear Lake. Going forward, they will not be making those investments anymore unless the client asks them to do, and I don't think that can be done in the fund of fund structure. So I think this is going to be eliminated. So it's, again, they're putting in these safeguards at the org level to try to move forward and address some client concerns. But I think we also got an indication that the transaction they've reached a threshold where the transaction has been approved by existing clients. They needed a certain amount of consent, which they've received, confirmed yesterday. So it's moving forward. Again, anytime this happens with any of your managers, you don't know what the future holds, right? And that we spend a lot of time talking about that when we're evaluating managers. All you can do is monitor it carefully and look at the things that they've laid out and try to, stay on them as to, are they executing that as expected? And we'll continue to do that.
Okay, thank you. Well, we're in the discussion period of with a motion on the table. And any other comments or questions regarding this motion? Go ahead.
So I am inclined to vote against the motion because I am leaning toward putting the 60 million with Abbott. We're not here firing Pathway. Pathway is still half of our portfolio. We're just doing a minor, what do you want to say here? Tweak, yeah, here. To see, Abbott has done as well as Pathway. The management is stable. So what I would be for is waiting a little bit longer on the how much more to give Pathway. That is next year or the year after when we again allocate money to. We could go back to Pathway, and still there will be 50-50 between the two of them. We're going to be 50-50 or 51-49 or whatever it works out where we are now, and we would have another year to kind of see what happens with Pathway. And Abbott is offering up, as I understand it, a reduction in fees. Is it, I don't know, it's minor or major, but maybe you can comment on that. So here's a chance to take advantage of an opportunity to reduce the fees that these gatekeepers charge us, and maybe when next year or the year after, when we decide that a Pathway is good, we can tell Pathway that they need to compete with Abbott on the fees. So my inclination at this moment is to, as I said, vote no on this motion, and if the motion were to fail, I would propose a motion where we give the 60 million to Abbott.
Okay, thank you. Any other comments?
Will you answer the question about the fees negotiation?
Yeah.
Yeah, so Abbott is offering a 20% discount in effective management fee if they get the entire 120 million commitment. So that takes the effective management fee down from 35 basis points to 28. The fee for
Future investment.
for future.
Just this commitment that you're making, 120. If you were to do 120 versus 60.
Yes, thank you. First of all, thank you for including this table. I asked for a similar table last year, and I appreciate the work and the transparency. So I really do appreciate it. So this would be a fee from Abbott to us. That's both management and the carry in here. there's also an additional layer, correct me if I'm wrong, of the managers that Abbott selects.
Mhm.
That gets charged to us, correct? Do we have data on that?
Yeah, there's an annual report that we do every September that was
Oh, that's-
presented to the board. It has a lot of detail on that, but yes, there are underlying partnership fees,
Mhm.
management and carried interest that are part of these fund of funds. This
Cor-
is just the Abbott fee. That's
Fair
all.
enough. But in terms of the projected fees on this table, which is lovely, quite frankly, I think it's quite informative and very clear. But at that, we're paying two levels of fees, right? Abbott and PAL. And then underneath there, they select the managers that in turn charge us. So those additional fees, the underlying managers on the projection schedule or
So
projected fees.
they technically, they charge the fund, you put an investor up, you get the net return of the fund.
So they're charging the
Not
fund.
charging you separately. It's embedded in the fund fee.
Is it?
Yes.
Okay.
So
Council?
Is there an
Okay.
opportunity to ask, I think Pathway has averaged 43 basis points and Abbott has averaged 35 basis points, and you're telling us that they're offering us at 28 basis points. Is there an opportunity to?
We did not approach Pathway to give them the entire $120 million. No, and the board at the last
No,
meeting.
no, no.
committed-
Is there an opportunity to ask Pathway to match the fee reduction?
Again, the reason Abbott is giving you a fee reduction is if you were to commit the full $120 million to them. That's what you're seeing on this page. We did not,
60, right?
you've committed 60 to them already. If you were to give them another 60, so it would total 120, they've maintained that they would give you a reduced fee, which is what you're seeing on this page. We did not approach Pathway and ask them what their discount might be if you were to give them the entire 120. And in fact, the board made a decision at the last meeting to give 60 to Abbott already, so you really couldn't do that anyway.
Question, can I amend my motion?
Yes, you may.
I may. Based on the conversation from the board and our advisors, I'd like to change my motion that we invest the $60 million in the Abbott strategy to take advantage of the similar performance, and we also get a fee discount.
So
Steve,
the
what's that?
second has to agree with that amended motion.
While that concentration in Abbott makes me a bit uncomfortable, I think given the fee reduction, that I amend my motion as well.
Okay, so motion and a second. Any additional comments? Mr. Wickman, vote on this?
So
do that?
you can call for the vote, but the motion, the amended motion by the original maker of the motion and the person that's second is to invest the additional $60 million in the latest Abbott fund. That's the motion.
All right. All those in favor, raise a hand.
Mr. Chair, the motion to commit the additional $60 million to Abbott passes unanimously 9-0.
Okay, and maybe suggest that at the workshop, we can
We will.
discuss direct investment, private equity solutions.
The-
And
The Education Committee will meet next week after the board, and I will recommend that to the Education Committee.
okay, let's talk about future meetings.
The only thing I want to, and Jim's already said this, that your next meeting is just next month. So we've got back-to-back week.
Next week.
Well, your next investment committee meeting is in March. Okay, you've got your board meeting next. That's something different. Your next investment committee meeting is in March, and in March, that will be the continuing discussion about private credit.
Thank you.
Is this the opportunity to add agenda items to future investment committee meetings? I understand that.
It's the opportunity to suggest that they be added.
Got
Yes.
it. I'd like to suggest that we look at the domestic equity strategy performance, and particularly the dimensional fund performance.
So I think the one question I would ask is that once again, since in March, we're going to be doing the full review of the allocation as part of the annual Allen's update of their capital market projections, is that also a discussion that we could have there?
Planning.
Okay,
Sounds like
So-
it will be covered.
right. So
Okay,
we'll
we cover it. Thank you.
We can, you can feel free to ask questions.
Great,
at meeting,
thank you.
for your,
I think that we previously had talked about the fact that we want to talk again about the 80-20. So yes, that can be part of that discussion.
Thank you.
Any other thoughts on future meetings, or shall we move to, this is our quarterly report with the flash performance update as of December 31st.
Yeah, so these are preliminary returns through December. We'll have a finalized performance report, or we should by the next meeting. But this should give you a pretty good idea of performance. The first column is market values, preliminary market values. Then we have fiscal year performance, so the first 6 months of your fiscal year, and then the calendar year of 2025. The big takeaway here is, performance has been pretty spectacular. Equity markets have completely roared beyond, I think, what anyone really expected. Particularly, I think the one big takeaway here is that the non-US markets were really the driver for the first time in a long time. There's a bunch of questions about currency today. That was a big part of it. The dollar certainly weakened collectively during the year. So that's a tailwind. Because when you own non-US investments, you not only own the equity, but you own the currency. So that's helped, unless you hedge it. Those guys all do, but your equity managers don't. So you see the numbers are great. I'll just go quickly over the 1 year numbers. Domestic equity, over 15%, slightly behind the market, and the headwind there, which is small cap, right? The small cap weighting, small cap has underperformed large cap, and DFA has underperformed the broader small cap market. We'll talk a little more about that. International equity, you can see returns are quite good over the 33.2%, which exceeds the index. The big driver for the outperformance is Fidelity's emerging markets portfolio, as you can see. It's about 5 percentage points ahead. Pretty good year for fixed income, up about 7%, which is the best return in an absolute sense we've seen from fixed income in a while. And your managers are both doing well, Wellington and Dodge & Cox. We move into your private investments here. Real estate, again, these are very preliminary numbers, and in some cases lagged. Private equity in particular is going to be lagged. Those valuations are probably maybe even June 30 week, but hopefully we'll have September 30 numbers by the time we publish the report. But that's always the case. As you can see, at least the positive numbers from real estate. We've talked a lot about real estate, and in that commercial real estate market's kind of bottomed out. We're starting to see some modest appreciation in that portfolio. Private equity positive, but lagging the public markets, which is again a theme that we've talked about. And then private credit, who you heard from today, putting up respectable returns. One thing I just wanted to point out about the market values, because this came out in their presentations today, is that Varde stands out there. As you can see, there's about 9.5 million of NAV in that portfolio. Their distributions have been much quicker than the other managers. So they pointed out that they're almost at one distribution. They're almost giving you everything you back. They only called 80% of the capital that you committed to them, so they didn't get the full investment opportunity. It's because the market changed, and then they gave you money back much quicker. So the balance of NAV right now is meaningfully lower. I think that's probably going to be the lowest return, lowest multiple of the three. Still respectable, as they pointed out, about a 9 IRR and a 1.4 multiple, which is certainly pretty decent. But the others will probably have a little bit higher returns and multiples. I think Fortress projecting the highest. Those cash flows are going to take a while to come back. Right? There's probably going to be, as you've seen from all of your private investments, it's going to be a little slower road to get it all back. And they provided some projections in their reports today as to how they thought that might play. So pretty great return for the calendar year, 14.6% preliminarily. Hopefully even higher when we do a revision, and then the fiscal year is on course. Still a long way to go, but positive. Happy to answer any questions that you might have about performance managers or anything else. But yeah, it's just Jeff alluded to. We're talking in more detail about private credit because you've created this strategic allocation now. We provided a few ideas the last meeting about how to build that out. We'll come back with some more specifics there. And then importantly, we'll do our annual asset allocation. Talk about the economic capital market environment, look at your portfolio, and any changes that the board might want to consider going.
Refresh my memory, was oil up or down during these two periods?
Up, I believe.
Up?
Like natural resources were pretty good
So
performance.
that explains KBI's under.
Yeah, their portfolio is so different.
Any other comments or questions about the flash review?
Well,
Well
I'll
done.
just state January has been a good month also, and so if it was January 31st instead of December 31st, it would be
Even higher.
even better.
Yeah, and internationals continued to perform well, and small cap outperformed large cap pretty meaningful in January as well, if I remember correctly. It was much bigger. It narrowed towards the end of the month, but it was still a pretty big premium, and that's a big driver to your relative performance because you have that small cap overweight.
Jim, yeah, Jim, in your opinion, on the international side, I know you've mentioned currency, dollar's gone down almost 10% in the past year. How much of that performance would you say is dollar depreciation, and how much of it would you say is real fundamental sort of, productive capacity increasing in international markets? And how much? Yeah.
Yeah, I mean, I'll come back with specific numbers when we have the final performance report, just to
Mhm.
kind of give you what the currency impact was.
Okay.
Do you know how much the international markets were up in their own currency?
That's what I don't have the number right.
Okay.
Because this is dollar based.
Yeah.
On a local basis, I don't have it. It was lower. I think better than the US, if I remember correctly,
Yeah.
but lower. I want to say the dollar weakened, what was it, like
10%?
10% on average versus a basket? So, roughly take that off would be kind of what your local market, still in excess of the US, but certainly not to that magnitude. Yeah, and we can talk a little more about, the drivers of performance in the non-US market. What you're going to hear is that, now, again, I don't have the specifics in front of me, but we all have heard the US theme AI, Mag 7, right? That's been certainly really the main driver. Not the case in the non-US markets at all. The technology weightings are much lower in the non-US markets, and the drivers behind performance last year were actually more value-oriented themes. Industrials and financials did well in the non-US market. So it's very different in terms of, the drivers, that AI theme. Certainly it's a global theme, but it's had a much bigger impact on US stock market performance.
Thank you, Jim.
All right. Thank you, David. Thank you, Jim, for helping us through this. Thank you to the board for great questions today. We are adjourned.